Welcome to the B.F. Anderson Technical Report for May the 3rd. This is a graph of the S&P 500. This is where we are now. This is our current situation. Now you can see what's forming here is a wedge formation. But take a minute here and let's just kind of look at what's been going on. If we go back to the beginning or a year ago, you see that there's a really nice uptrend here. This is where making money in stocks becomes very easy. It's an easy situation because you can see the moving averages are in an uptrend, the price of the index is in an uptrend, but all of a sudden here, starting in end of January, February this year, it looks like a change of character, a change of personality. So what we've got now is a lot of volatility, no trend. If anything, we're moving sideways. We're basically got the correction, rally that failed, pulled back again, and so far it looks like this rally is failing as well. So if we can look at all the economic numbers and really, and I'm going to show a graph here in a minute that basically says the economy is fine. We're not in any kind of economic predicament here that's negative. It's just that I believe that the institutions are, for some reason, the institutional, they're not buying, they're selling. So what my attitude would be at this point would be get out of the way. This is really not the best time to be trying to make money in the stock market. I would say this would be a good time to be very defensive. I would keep my cash balances where they are. I would hold off in any new buying at this point. Let's just see how this works out. And I'm going to show you why here in just a second. But just to kind of let you know, here we are, the lower moving average, which is the 25-day moving average, is basically flattening out. But then yesterday we got the pullback in the S&P that pulls us back down below that lower moving average. So if we don't get a rally, and so far the futures are down this morning, if we don't get a rally, this moving average will continue to turn back down again, and you can see the upper moving average is already starting to roll over. So no uptrend. This is not an uptrend. This is sideways. And I'll just tell you, I've studied trend following for years, and it's a skill. It's something that I have learned, and I have basically learned that you can't fight the trend. The trend is what it's going to do, and that's that. So let's go back and look at an example of past situations. Now, what I did over the weekend is I went back and looked at 50 years of corrections in a bullish uptrend, and I came to some very interesting conclusions. The first conclusion I came to was if you're not in an uptrend, you're pretty much wasting your time trying to make any money in the market. It's going to be a very difficult thing to do. I would say the odds of picking a random winner, you might get lucky, that kind of thing, but you've got to have an uptrend. So what I went back and did was studied 2012. And you can see in 2012, it was basically a sideways year. It was not a good year. It was a trendless year. It was a frustrating year. But as I've always said, difficult markets are generally followed by easier markets. But you got to stay flexible, which means cash. You want to be in a flexible position because what I've also learned is that the stocks that led in the prior cycle, the prior uptrend, will basically run out of steam in here, and then a new uptrend will get started, and it'll be a whole different ballgame. It'll be a whole different group of stocks, and I'm talking about the leadership. So if you notice here, back in 12, we got the drop, the first correction, then we tried to rally just like we are now, okay? And once that lower moving average turned up, you got another move, but it basically failed, but it failed at a higher level than the prior correction. So even though we just weren't out of the woods yet, but then we had another pullback, and then you can see that lower moving average is starting to turn up. The index gets back above the moving average. Then the moving average crosses over the 25-day, crosses over the 50. Boom, you're off to the races. So what I'm pointing out here is that you have plenty of time. It's not like you have to rush out and you're going to miss some kind of bull market. What I have found with trend following is you will never miss an uptrend because the moving averages will pull you in. And so what Gerald Loeb has said in his book, he says, fools rush in on Wall Street, and that's a disaster. So what I'm telling you is you don't need to rush in. Now what I did is I also went back. Now this is another graph of the S&P, and I went back to 2016. And I took out the price of the index, and I have nothing but the 25-day and the 50-day moving average. But you can then again see the same basic pattern where you get the correction, we going into the election, and then boom, you break above the 25-day breaks above the 50-day, and you're off to the races. And this was a nice 12-month move in 2017. So there is no rush. Now, talking about the economy, if economic conditions were deteriorating like they were back in 2007, this is a graph of 2007, all I have here is a ratio of the small cap stocks which do poorly in bad economic conditions and comparing it to gold. So in other words, if the economy's tanking, everybody's going to run out and buy gold, and the price of gold is going to go up. So what happens is that the ratios started to deteriorate in 2007, way in advance of the big drop that came in 2008. So you can see here that this ratio shows that when it's going down, the small caps are going south, and gold is going north. So gold was outperforming here. You can see this was a warning that the 2008 financial crisis was looming on the horizon. Now, if we go to where we are now, it looks nothing like the 2007 graph. It's the same ratio, and you can see a smooth uptrend here. Small caps are going north, and gold is going south. So it's basically telling you that the economy is fine. We don't have any major economic problems out there. We're just having a technical correction in the market. Now, I did want to point out the Value Line Geometric Index. This is your average stock. This is not a market cap weighted index. It's an equally weighted index. So it gives you a truer picture of what's going on with the average stock. So you can see, going back to 1998, the average stock has bear market, rally, bear market, rally, and then a third bear market, and then we're finally pulling out of a price box that's been going on for 20 years. So it seems like the longer the base, the greater the race. The same thing I have pointed out happened between 1966 and 1982, and starting in 82, the Dow was at 1,000, and everybody knows where it is now. But I do believe that this was caused by the fact that the economy went bad and we went into a deflation type of period similar to 1929. So this has been an extremely challenging area to be invested in the stock market. But the question we now have to ask is, are we now moving out of deflation and into inflation? And I have a gut feeling that's the case. I think we're starting to see shortages of labor. This could be very inflationary. So let's get into the top five. And speaking of inflation, here's an oil stock. The price of oil seems to want to go higher. This stock has been on a tear, doing extremely well. Continental Resources. Then here's the therapeutic company called Heron Therapeutics, continues to make the top five. Stock just made an all-time new high. Netflix has come back on the list again. The company came out with really good earnings. This is a very good company, very good situation. I think we should keep an eye on Netflix. But like I say, as long as the general indexes are not behaving themselves, it's going to be kind of difficult to do any buying. Here's Shutterfly. Now, this is a fairly recent company. The stock is really doing well. It came out with earnings the other day, big gap up here. This company has made a recent acquisition that's pretty much changing their business. They are going into school photography, things like yearbooks. I mean, kind of interesting. Probably a good idea. Then last but not least, Urban Outfitters. This is a brick and mortar retailer, but it continues to do well and recently hit a new high. So if you have any questions, give me a call. But the main conclusion here is there's no rush. This correction, someone asked me the other day, how long will this correction last? And I said, it's kind of like asking me how long is a piece of string. I mean, how do you know? You don't know. So the other thing to realize too is that a lot of bear markets start as corrections. Now, I'm not saying that we're going into a bear market, but I do think that we need to wait and just stay patient because things are just not moving up. They're moving sideways at best. Thank you very much. Let me know if you need any help.